everything that happens in the market is about traders, whether they are individual traders like yourself or me, or if they are an institutional investor, or even some of the really big macro accounts are entering the Forex, and they are using the carry trade specifically all about the interest rates. They are looking for the spread between the interest rates. So, and I'm going to give you that in detail. So that's a real driver. So, and the bigger that spread, the more people and the more institutional traders are going to barrel onto the carry trade, and you'll see it start to take off. So, in simple terms, when you trade a currency pair, particularly on the spot market, you are buying one and selling the other. The one that you are selling is actually a currency that you are borrowing in order to use that currency at whatever interest rate that is to purchase the other one. And so therefore the difference between that those two interest rates is the difference that you owe the bank, so to speak, and that would be, or the bank would owe you, depending on how it goes. So carry trade is simply borrowing a low interest bearing currency and purchasing a higher interest bearing currency. And so the difference is, for instance, if you go to the bank, if you borrow something at 1% and then you sell it at 10, you're going to get 9% interest rate on that. Okay, obviously the bigger the better, and we're going to see some of those. Okay, and obviously for years now, the Japanese yen has been the real driver of the carry trade because it's consistently been the lowest interest rate currency out there. But that becomes a problem when the Bank of Japan starts to intervene. Okay. Again, it's a game of interest rate futures. And when we say interest rate futures, essentially everything that's happening in the Forex is because the traders are out there and they are looking at that market and they're comparing economies. The economies are based, the evaluation of the economy is based on its interest rate. So whether you see that it's because manufacturing is down or jobs are up, whether it's in the United States or Japan or wherever, traders evaluate that information, or even something that, like, Trichet comes out and says in Europe about, indicating there may be an increase or decrease in the, euro's value. Traders sift through that information and determine whether they believe that that's going to be a positive or a negative to the interest rate for that currency. Again, it's buy the rumor and sell the fact. And so, one of the things that happens by the time that a nation actually announces its new interest rate, or the bank of that nation, it's almost too late. And so when you see, unless it is a real surprise, like they doubled up or they stayed flat when it was expected to increase, unless it's a surprise, you probably won't see it move too much because the traders have already calculated that in, and so there isn't a lot of movement to make on that currency. Surprise interest rates changes. Okay, that's where you see some huge spikes in the market. Or if you see it do what it's supposed to, it may very well be that you see it do a short run up, a short spike, but then it drops again. So you see some movement, but it comes back down to where the institutional investors had already determined it was supposed to be. And it will actually change the market direction. Okay, so we have a course in the 1000 Pip Club where we actually evaluate interest rate sentiment, the FXStreet, which is the Forex Futures Index, and so that where you think it's going, and so that becomes a driver as well as the trend on where you think that market is going. Okay, let's look at the difference here, some of the variances. Here are the current interest rates. And obviously the Aussie leads the pack at 4.5, and the yen is trailing behind at 0.10, which is effectively zero for the most part because they gave themselves a range. Let's say I listed this as a difference in basis points when in fact it's a difference in just a percentile difference. So you see the difference between the Aussie and the New Zealand is really 200 basis points. That's huge, but when you get down to the difference between the Aussie and the yen, 440 basis points, that's a great trade when the Aussie is going up. Not so great when it's going the opposite direction and that 440 basis points charged back to you. Then if you look at the New Zealand at 2.5 versus the euro at 1.5, you start to see the numbers drop. So the difference between the Aussie and the yen is 4.4, whereas the difference between the New Zealand and the yen is 2.4, and you can see the numbers have almost cut in half here. And then it goes down. These are the numbers based against the euro. And you can see the euro yen is still a good carry trade. Certainly not the best out there, but it's pretty decent. And the euro yen is a great pair to trade anyway. It's such a market indicator. So 115 basis points is not a bad deal on that one. But then when you get down to trading the pound yen used to be everybody's favorite to trade. It was a great spread. And you could see that pair just make huge moves in the day. It either kill you or make you rich. And so, I got to the point where it was just a little too, volatile for me. So I pretty much stay away from the pound yen for a long time when it was doing that. And then when you get down to, the pound these days, where it used to be the pound yen was the best, deal out there, certainly not this day, not even qualify as much of a carry trade at all. So you can see that, basically the way it works is that you buy the Aussie, let's say the Aussie yen, you're going to buy the Aussie, and sell, the yen. So Aussie yen is going to be a positive carry trade if you're buying it. And that, you would make the 440 basis points. You take 10 lots out on that, then you're going to end up, or your leverage is 10 to 1, then you're going to end up with, 44%, improvement on your trade. So you're ending up, a 44%, interest rate. So, to your favor. However, if that pair starts to turn around, you're going to lose that, pretty quickly. And I'm going to show you that you're going to lose it a lot faster than you will ever make it. And so we're going to look at that carry trades are great unless you're in a volatile market. Okay. Carry trades occur, generally at the end of the New York trading day. And then, so anything that's sitting there, any position can be a carry trade if there's a variation in their interest rates. You will see the interest accrued, or you will see it, credit or debited to your, account at that point. Any interest earned for the previous day is credited to the account, and any interest accrued is debited at that point. So you're either in, positive status or a negative status for that day. Market is closed on the weekend, so everybody loves triple rollover Wednesdays, and that is when you see it compounded 3 times. So you definitely, if you're in a sell status on the carry trade, you definitely want to be out by 5 o'clock on Wednesday, if at all possible. Holidays are generally accrued 2 days prior. Now, this is important. Brokers will either, not, in many cases, there are brokers who give you all of it, and there are some who assess fees, and there are some who will only give you back part of it.